a good, solid day for the markets. As I showed you at the beginning, 664 points, up and stayed there, and it's on growing hopes of a December rate cut. Some new economic numbers showing signs of potential weakness that might lead the Fed to move in the direction. The Fed's been split on what to do next, and many economists are divided. So this really is the case on the one hand, on the other hand. So, for instance, Nouriel Roubini in today's FT says that the US tech sector is strong enough to overcome the headwinds from tariffs. No reason to fear a market crash anytime soon. However, Ken Rogoff, also a regular on our program, he says to the New York Times investors are ignoring growing risks and that stock valuations have outpaced future growth. Andrew Hollenhorst is the chief U.S. economist at Citi. Do not for 1 second, Andrew, think you're going to get away with this. Not for a second. Where are you on this question?
I think it's easy to say on the one hand, on the other hand. But look, a remarkable thing about human beings, I think what's caused us to continue to advance the technological frontier is we get very excited about new technology. And so this new technology that's bubbling up that is affecting markets. And I think there is a lot of money and investment that's chasing that technology story. But on the rate cut, I think I would come back to the economic fundamentals. We have inflation that is above target but has been cooling. We have a labor market with very low hiring and an unemployment rate that's moving up. So on that one hand, on the other hand, I think, yes, there is a balance that has to be struck, but to me, those downside risks to employment are really the dominant risks that the Fed should be worried about, and a cut is warranted at the upcoming meeting, and I think they will cut at the upcoming meeting.
When you look at the numbers and you do the on the one hand, on the other hand, how much of your final decision or your view is made up on a gut? And I don't just mean a whim. The number feels one way versus the number feels the other way.
It's a great point, Richard. I mean, you take all these numbers in and you try to put them together and you try to understand what is actually happening in this economy. That's always a difficult task. It's been especially difficult because we've had a government shutdown, which means some of the data are not available. And what I try to do and what our team tries to do is look through all of the numbers on the labor market, all of the numbers on inflation, and really say, what do we feel? That's where the gut comes from, I think. And the gut feel that we have is that these labor numbers are showing us that we do have a cooling in the labor market, and that warrants a rate cut.
Is there any evidence in the numbers that the consumer is wearying and sort of flagging a bit? Because that would be not just the canary in the mine. I mean, that would be the dynamite.
This is where it gets very messy in the data because most of the data that we have are about total spending in the economy. And total spending in the economy is holding up okay. Consumer spending overall is holding up okay. But we have lots of anecdotes. We have lots of suggestive data that consumer spending is really being held up by those at the upper end of the income threshold the spectrum, those at the upper end of the wealth spectrum, who have done very well in this economy that are benefiting from higher equity prices, like we were talking about, from higher home prices. And then think about the rest of the economy where people are experiencing higher rents, higher food costs. That is probably where we're getting a slowdown in consumer spending. And when you look at prices, I think one of the surprises is that we haven't had more pass-through from tariffs and costs into final consumer prices. One of the reasons that firms don't pass through those cost increases is because they're sensing that weaker demand.
Okay, but this then comes back to the Fed chair's point that he's made repeatedly after the meetings. Is it a one-shot shock, or does it feed into something more systemic? I mean, most, or a lot of people are surprised that there hasn't been a higher level of inflation as a result of tariffs. But I do question whether that's just because the uncertainty. You dare not put your price up because you don't know how it's going to be affected and you don't know what the tariff might be a week next Thursday.
I think there's an element of that. And I think what we've seen are prices that have gone up a bit, and maybe will go up again further into even 2026. We hear about some retailers that are going to try to be safe over the holiday season and not raise prices during the holidays, but then maybe come back in 2026 with some price increases. So this is taking time to work its way through the economy. But I would agree with, I think it is the mainline consensus view of economists that this should be a one-shot issue. This is not something that we're seeing affecting inflation expectations. It's not going to cause persistent higher inflation.
Finally, Thanksgiving on Thursday. I wish you and your family well for that. But let's put you to work. How significant is it now, the retailing from Thanksgiving to Christmas?
This is a very important season for retailers. There's a reason they call it Black Friday. You're trying to get back into the black. At least that's one of the possible explanations of how we got that name.
Interesting. I never thought of that.
So this absolutely critical period for retailers. It's a critical period for labor markets. We typically see lots of hiring in the holiday season as those retailers are trying to move their goods. So we will be watching that data. That's going to be very important in terms of assessing how we're handing things off into 2026.
I'm grateful for you, sir. Thank you very much indeed.
Thank you.